All right, how's everyone doing? Hope everyone's enjoying the holidays. I've had uh, too many holiday parties in New York, my backyard. I think I've gained 5 to 7 pounds or so. It's been a lot of fun. By the way, I've got an upgraded mic here and camera. We took advantage of Cyber Monday. If you're not hearing the audio, please let me know. I'll validate that's all working here. Yeah, just give me a quick comment if that is working, if you don't mind. Thank you. A couple quick thoughts I wanted to talk everyone through here. One is some thoughts on next year from markets perspective, animal spirits, Twitter momentum. We have a new thematic basket, thank you, called Twitter momentum. I want to share that with you. It's part of this animal spirits concept. Autonomous driving, a lot of news around that from Tesla, from GM, from Nvidia, Nvidia in China. We can go in other directions too. So just let me know what questions you have. So first off, I thought I'd introduce this by sharing I thought a funny story with my two boys. I took them to the circus in New York this past weekend. Bloomberg has a circus for all their employees, and we got a hookup there. So my oldest son is 6 years old, and I've been trying to instill the value of like work and earning money to pay for stuff, so he doesn't get spoiled. Because now he's at the age where he understands money and he wants money to go buy whatever toy he sees. So, been trying to use the word no more often and have him become accountable for decisions, right? So his younger brother is 4 years old, picked up like a Nerf gun. The 6 year old went for a mock iPhone, so it could be like mom and dad. I said, you shouldn't buy that toy. You're not going to enjoy it. Sure enough, he got bored with that. Wish he got the Nerf gun. Now he beats up on his little brother. But so we go to the circus, and on the way back home, we're riding in the car. I said, "Well, so what'd you think?" He said, "Dad, I like the circus very much." I said, "What'd you like?" He said, "I like the trapeze." I said, "I like that part too." And he says, "Dad, I want to join the circus." So I say, "Son, your dad is in the circus, actually. It's called markets. I will tell you everything you want to know about the circus." So, uh, so that's really a good headline for where we are, right? Ever since the Trump election, we have had a major animal spirits rally. There's a good video I did around this the day after the election from Brian Park. I'll post in the notes below talking about animal spirits. We saw the NFIB Small Business Survey come out a few days ago, 3 year highs in small business confidence, and that is a real effect that's going to make itself felt in decision making for small businesses and for corporate executives. Bill Ackman was at the New York Stock Exchange today. Trump rang in the opening bell, uh, taking credit for the Santa Claus rally, right? So you're going to see more capex spending. So overall, I think next year will be good. Earnings are going up. Earnings are going up. Yes, valuations are high, but the data shows that so long as earnings growth is greater than 8%, you're not likely to get a negative left tail outcome. So overall, I feel pretty optimistic around that. The question is really, how do you position in the market? I want to talk about that. Talk about what themes are working, what themes are not working. So to start off with, why don't we talk about this concept called Twitter momentum? So there are a basket of about 2 dozen stocks on Twitter, and I have a watch list for them, and I've been tracking them. We own some of these names too, by the way, but we're selective. And the story is, first off, that animal spirits have performed extraordinarily well. I'm going to share my screen now so you can see that. Now, animal spirits are noted here at the top. This is a thematic basket. I'll show you the stocks that go into this. Over the last 1 year, they're up 56%. Now, most of this gain is in the last couple of months. Okay. It's the number one theme. Now, this theme's actually lagged most of this year up until starting around October when you got into Q4 seasonality, and then it was accelerated after the election. You can see other categories have done well, such as technology. That includes Mag 7. Software's caught up while semis have pulled back. Utilities have done pretty well, although utilities in the recent weeks, as you can see here, are pulling back. and healthcare has been in the dumps. We wrote about healthcare a few days ago after this, vigilante assassination, and we took out a position that we are tactically bearish on healthcare. That came out uh, December 7th, right? Today's December 12th. If you look at the healthcare ETF, you can see that this thing has totally dumped, right? So there's some interesting questions on how you position on all of this. And there's a big question on what are Trump's policies around Medicare. Now, he campaigned on not cutting Social Security and Medicare, which is bullish for this category. Republicans are bullish in general for these kinds of businesses. But we'll have to see. The public outrage is so significant around uh, their healthcare experience, including with their insurance companies, that we think it's best to just stay out of the water. This is a good example of changing your mind quickly. If your new data presents, I have no problem changing my mind on a category and just placing capital where it is better rewarded. So you can take a look at this post if you want to learn more about our reasoning here. We do think there's some interesting ideas around generics, though. If you want to cut the deficit, you want to cut costs, uh, encouraging the use of generics is one way to go ahead and do that. And there are other businesses in that category that are not indexed to Medicare or Medicaid. There are other insurance businesses that do that, but they are selling off anyway. The whole category is selling off. It's indiscriminate selling. So those are the kinds of assets I would want to pick up at the appropriate point in time. When is that? You don't know. You wait. You wait for the selling to stop. You wait for things to settle. You wait for bargains to emerge. And if you see enough of them, then you can put your toe in the water and start to establish a position there. So that's our quick thoughts on healthcare. But back to animal spirits. So I'm going to share another screen for you here. So I think you'll recognize many of the names on this list because people talk about them. These are consensus Twitter names. And this goes back to a point I've raised a few times over, that investing is social. And I do think platforms like Twitter and Reddit have changed how or influenced markets in ways that they have not before. I'll show you an example of that. So the headline for this is that Twitter momentum stocks have outperformed stocks that are not on Twitter that share the same factor exposures. So there's a real phenomena that's at work here. Here you can see it. So now this basket was down today. Over the last 1 month, you can see that the gains have been pretty significant. I'm going to sort this by, let's sort by year-to-date returns, by the way. I mean, the year-to-date returns are significant. By the way, we own Dave. That was our pick from January of this year for those that follow. So I like momentum. We also own App. These are the two best in this list. I didn't know that when I sorted this, by the way. That was a pleasant surprise. But I like momentum, but with value, because I have a chance for multiple expansion. That's the idea. Like when we bought App, it had a mid-teens multiple. Now it's 50 times earnings, right? When we bought Dave, it had a low teens or a high single-digit multiple. Even now, it's only 19 times, still cheaper than the S&P 500. That's my approach. I like momentum, but I like value as well. Ideally, I can get quality too. But quality now in this market is expensive, especially if you see Costco more expensive than Nvidia or FICO more expensive than Nvidia. And Nvidia is the speed of light in this market. Thou shalt not move faster than the speed of light, right? So, but yeah, this is a Twitter momentum market. Look at these names, right? You probably recognize several of them. And my expectation is that the momentum market, the momentum factor overall, will continue through year end, because I think the Fed will cut rates this month, even though they shouldn't. It's a Goldilocks economy, but they will, and that'll help the show go on. Although I think in early Q1, we'll see that Twitter momentum factor start to fade. And the reason why I say that, and maybe beforehand too, by the way, it's hard to time these perfectly. You really got to stay on top of it. Like today, we saw a weakness in this theme. But the reason I say that is that stocks that have these same factor exposures are softening elsewhere. The difference is that they don't have the Twitter pump. And the pump can go both ways. And we saw this pump last year at this time. You had the Q4 seasonality is always very bullish, generally always bullish. And this year is no different. And it's absolutely motivated by this Trump bump phenomena, this animal spirits, which you see evidence in things like the NFIB small business survey. Consumer confidence also went up. The prospect of deregulation and tax cuts is getting people excited, right? So you can see that here. So that's Twitter momentum. I think this is a super interesting index to follow, and we're going to actually create some indices around this to track this. Take a look at ARC. ARC is interesting because ARC is loaded up on the kinds of factor exposures that Twitter momentum stocks have, except they tend to lose money. So Kathy Wood likes to pick unprofitable businesses. She has reconstituted the index so it has more exposure to some of the names you just saw. And so this was one of the most significant wealth destroying ETFs of all time, still is. That's not me, that's the Wall Street Journal saying that, and you can evidence that. But it's also had a significant rally. Now, when that animal spirits rally phase, and inevitably it will bleed out again. You see that where these black lines are marked here. So in February of 23, that was the end of that rally. In July 18th of 23, same thing. By the way, you also saw a top out around in July of this past year here as well. So the point is, if you're sitting on massive gains in a Twitter momentum stock, don't confuse that with the larger tidal waves or the factors that are influencing that stock price movement, because it's the basket that's moving together, right? So if you look at the holdings here, you can see that Tesla, Coinbase, Palantir, Robinhood, Shopify, those are the same kinds of names we saw in the Twitter momentum basket. So wanted to add some perspective around that. By the way, feel free to toss out any questions that you might have as I go through this. So animal spirits are on. Overall, that's bullish longer term. People are excited. They're going to spend more. They have more confidence. They'll have more household formation. They're going to hire more people. There'll be more CapEx investments from large companies. They have more clarity in the regulatory environment. So that's all good for next year. So that's one message I wanted to share with you. Now, autonomous driving is coming into focus. Actually, before I get there, I do want to toggle to this. You're starting to see these headlines come out now. Here's the headline. S&P 500 record rally shows cracks as most stocks are left out. They're talking here about narrowing in breadth and a breadth contraction, right? So the article goes on to say that it's a top-heavy market. They talk about how equal weight S&P has lied against cap-weighted indices, and it's continuing on its downward path, and that this basket has fallen for 7 consecutive days through Tuesday, the longest streak since 2018. So let's go take a look at the equal weight index. Actually, the equal weight index you can pull up is RSP. This is the equal weight S&P 500 index. So if you see what happened here is after the Trump win, you had a massive gap up where that category lifted off. And again, this category includes names like financials and regional banks and insurance companies and industrials and material stocks, essentially a lot of names that had lagged the Max 7 category. And then it gave back, it had another pump here, and now it's almost back to where it was immediately the day after the election, right? Again, so one of the lessons is, don't chase. The other key point though here is that, this is in a steady uptrend. In fact, I wouldn't be surprised to see that this downtrend they talked about in the article end, and that could end maybe tomorrow, let's say, or early next week. We'll see. But the point is, this is still in an uptrend. And when you start to see headlines like that come out, where people are growing more fearful about that, that actually might be time to pay attention, and take notice. But this category overall should do well next year because they'll benefit from the factors that we've talked about earlier. And I also think Max 7 categories will do just fine next year as well, because those are incredible businesses that are growing earnings. We obviously like certain names in that, like Nvidia and Meta and Google and Amazon, but those are world class businesses that will continue to grow earnings based on our analysis. So I think you'll have a good year next year. Now we've had two back to back years of 20% plus. So I don't think you're going to get another 25% banner year next year. Uh, but I think you will get an up year. The main focal point next year, the fly in the ointment, the thing to focus on will be, do we get inflation to come back? Because right now inflation, like CPI is around 3%. Is the Fed going to throw in the towel and just kind of accept that? They won't say that publicly, but market is pricing out further rate cuts based on the recognition that there's no recession and the inflation numbers are still elevated. If they accept that, that's actually bullish for risk assets, right? On the other hand, if they grow hawkish and Jerome Powell is replaced by Kevin Warsh, who is a high bandwidth, extraordinary individual, that would be more hawkish for the Fed. That's the main question to look out for next year: is do we see a resurgence in inflation with this building up of animal spirits, right? At the same time, if tariffs kick in and it's harder to grow labor supply, those are inflationary. So I'm not saying that's going to happen. I'm saying that's what I want to watch and check and monitor and measure. But overall, I'm constructive on how next year unfolds. We're just washing out some of the excess from these significant FOMO rallies. All right. What's happening now is the Mag 7 category is catching up. And these are quality businesses. So you're actually seeing a quality rally now. So, after the Trump election, this category really didn't do anything for 2 weeks. Here it said buy Mag 7. That was one of our calls. Now we're at all-time high. So you're just seeing a catch up in this category. And like water sloshing from one end of the bathtub to the other, different parts of the market are taking turns rallying. Overall, that's good. There are some categories that have some challenges though, like energy. Energy's been in the dumps. Greater oil production means a lower price of oil, lower gas prices helps consumer spending. That's great. It doesn't necessarily help energy companies that don't want to increase their production. They want to grow profitable market share. It's a very different energy climate than we had previously, say like 10 years ago, where the strategy was, you know, pump when you had more deregulation. So it's a different world now in how these energy companies are operating. But I do think energy will do well next year too. The category is just very cheap. There's a lot of free cash flow. There's buybacks that are happening. The regulatory environment's favorable. And if inflation comes back, then the energy category provides a natural hedge too, because they generate revenue that's indexed to the price of a commodity. That commodity price will go up in an inflationary environment. So let's jump to some other topics now. Um, where should we go here? Okay, autonomous driving. So a lot of news coming out in the last few days. One is GM has abandoned Cruise, their autonomous driving program. Uh, and I'll see if I can pull up an article around this. So the main story here is that it looks like unless you're a mega cap company, it's going to be hard for you to be in this race. At the same time, Google is gaining market share with Waymo. Right? Waymo is authorized now in Miami. They're authorized to provide autonomous driving in Austin. So Google is a beneficiary of this. It just takes billions and billions and billions of dollars to be competitive in autonomous driving. Now, Google's not making money with Waymo. The unit economics are upside down. To have a Waymo product, they're using LiDAR technology. It's far more expensive than the technology Tesla is using. It's also more accurate. There are different trade-offs around this. But you need to be a cash guzzler, and it kind of brings up the question of monopolies, right? I think Google's a monopoly. That's why I own it. But they have the wherewithal to fund these investments, which ultimately will benefit the public. in a number of different ways, but they can do that because they're a monopoly. So, uh, I'm glad to see that innovation. Apple obviously bowed out of the race by abandoning their car project, which I think was a mistake. But so GM is bowing out. I think that's actually good for GM because it will increase their earnings. It will increase their free cash flow. The question for GM is really going to be: do tariffs negatively impact their cost, their cost of goods sold? Because a lot of automotive production has moved to Mexico. And by the way, for Tesla, that's the case as well. In fact, Tesla is planning to open up a plant in Mexico. Recently, they scuttled that, and because people are responding to the political wins. You can see where GM now is here. So two things hit GM. One was tariffs. So this red bar here, that was the negative news on tariffs. Here they abandoned the EV business. I think that's actually bullish, but people that think that's bearish will wash out shortly. So actually kind of has an interesting entry now, I believe. But by the way, this is also a good example of not all news prices in instantly. This is not the case. I started off the call looking at healthcare. I said, here's when we got out and bad things happen in healthcare. Same thing with GM. We saw this hit the 50-day moving average, and we have a platform that alerts us to this. And we said, no, that's not the time to add to that because there are changes taking place in the industry and the sector, and all that's still getting priced in. It takes time for these things to get priced in. GM is a good example of that. So the other player that's getting involved in the autonomous driving category is uh, Nvidia. So Nvidia is also eyeing a big China expansion. Nvidia is maybe one of the most significant companies geopolitically. If you think about what they're doing and the game they're trying to play. So let me pull up an Nvidia article for you. Nvidia and autonomous. So Nvidia is focused on adding staff to China to bolster their autonomous driving capabilities. And it's likely to the fact that I expect you'll see the Trump administration announce a federal framework for autonomous driving that will benefit Tesla and other automakers too. Now, recall the current state of play is you must have a license in a state or a municipality to have autonomous cars. So I think that's going to change. But NVIDIA is making a play for autonomous driving. Now, this is actually old news. If you've been following NVIDIA closely, like we have, they've had this business here. They are dialing it up, though. And they're dialing it up in China. Why China? Well, China already has cost leadership position in autonomous driving, right? I mean, they've got multiple EV and autonomous players like BYD, NIO, and others, and they're very good. And they have lower costs of production than their US counterparts. So it makes sense they focus on China. But NVIDIA is basically the picks and shovels play for autonomous driving in the same way that NVIDIA is the picks and shovels play for AI. So if you want to bet on AI, you can bet on the like OpenAI, Meta, Llama 3, Amazon, Claude. There's a lot of ways to play AI at the app layer, like search engine wars all over again. They're very expensive plays. They're often consensus and they're therefore priced efficiently at best or overpriced. But I do think NVIDIA is a natural picks and shovels player for autonomous driving. There are other players too in the category. Uh, we're still researching those. I don't own them, but players like Mobileye, for example, there's a bunch of lidar companies. They're all in the dumps, by the way. Their trends are down. They're generally losing money. But I think NVIDIA is in a good position to benefit from that trend. It makes sense that if you are a GM, a Ford, or other automobile company, you're going to have to make one of two choices. Either you're going to rent Tesla's infrastructure. We have yet to see a major deal between Tesla and another automobile company, by the way. There are channel conflicts. There's a lot of considerations around that decision. Do you work with your competitor to rent their technology? Or do you work with a neutral picks and shovels player? Right. So that's something to keep an eye on. And the reason why that matters is because companies that can stack multiple growth S curves together and have another magic trick, another rabbit to pull out of their hat, can continue to do well, right? For Nvidia, it started with gaming, then they got into crypto mining, then AI, and just when growth seems to top out, they pull out another rabbit out of their hat. I think autonomous driving is a very real commercial potential in the back half of this decade. You're seeing it work successfully in multiple cities in the United States, and China is even more aggressive about that. So one of the things we'll have to do is bring back. We brought on a portfolio manager last year around this time who walked us through the China market, and we'll have to get their perspective on that. So autonomous driving, that's a topic I wanted to share with you. Keep an eye on that. Pretty exciting for the future of humanity. I can't wait. I have no idea why they let me get a driver's license. You really do not want to be in the car with me. They say uh, a majority of drivers think they are above average drivers, which is like a paradox. I'm not in that bucket. I will tell you, I'm a below average driver. I cannot wait for autonomous vehicles. The future can't come fast enough. So, what other headlines am I looking at? Look, people really want SpaceX shares. Take a look at this one. All right. I'm going to share my screen here. So, there are some closed end funds that are publicly listed that have access to SpaceX shares. They were trading at a discount, 50% to NAV, as recently as 6 months ago, by the way. And they have all ripped. So, this is part of the animal spirits story. So what is this? November 6th was the election. Look at that. This thing was going nowhere. This thing was going nowhere. This DXYZ has exposure to SpaceX, as well as a number of late stage venture capital companies that'll go public one day. And then it's just kind of ripped higher, right? So that's animal spirits for you right there. And this is another reason why I expect to see the IPO market come back soon. I think the first half of next year. Here's another headline around that. So here's a headline from CoreWeave. So this came out this morning. Nvidia backed CoreWeave shakes up cloud market plans 2025 IPO. The bankers estimate that it'll price at a 50% increase the most recent round. This is another picks and shovels infrastructure play. We're an investor in CoreWeave, by the way. We've been investors since their round last year, and we re-upped in the most recent round as well. But that's going to bolster animal spirits even more. When you get the IPO market going, investors get excited. Usually see quality deals up front. CoreWeave is an example of a quality deal because they are fairly priced. And then you get sloppy deals in the back half of the IPO market. And that's when you want to start to reduce or recalibrate your exposure to equities, right? That's kind of my other factor I'm looking at. So what happens with inflation in the back half of next year? What happens to the quality of the IPO market in the back half of next year? If things get la and inflation isn't slowing down, then maybe in the back half of next year, there's a rotation that is setting up there. Maybe the rotation is the healthcare stocks, by the way, which would be the ideal name to own if there's a pullback because they're defensive in nature. Right? Healthcare did very well in 2008. Healthcare is not pro-cyclical. These are companies where they get their revenue from primarily the U.S. federal government, and people aren't getting younger, right? So the demographic pyramid is only benefiting that. So those are some thoughts think about how next year might play out. We'll have to see, right? When you get new information, you just got to update. But that is the current lay of the land. What else? Any questions? Let me know. So categories that I'm spending time on. Let me tell you where we're focusing our efforts. And I also want to share with you categories that are working and not working. Okay, so this is a fresh report. We're refining this. You're going to see a lot of colors on the page here. And here we have different investment themes. So these themes are baskets of securities that we've defined. Sometimes they correspond intuitively to like an ETF. Sometimes they don't because we want a more precise expression of a theme. But what's working? So big tech is working. That's again that Mag 7 theme we're talking about. These are dominant businesses that have extraordinary competitive advantages, and they're cheaper than most of these SaaS companies and cloud companies, which haven't had a nice counter trend rally. And what you can see on this is what are the returns over different time frames, as well as the relative strength. Is it overbought? What's the distance from their moving averages? And also the price to earnings ratio, their forward PE percentile over the last 10 years. It's a great way to see, is that theme expensive? So this is saying the trend is up. It is now getting overbought, right? It had gone nowhere after the Trump election, and now in the last week, it's really cranked higher. It's just now getting overbought from a relative strength perspective, but it's cheaper than it has been historically. So Mag 7 can continue to run next year. That's one. Semiconductors are weak. Look, semiconductors, we were excited about the first half of last year. They got quite expensive in April. The big challenge has been around Trump policy to semiconductors, especially around export controls, right? So in July, I want to say 18th, Trump gave a speech saying Taiwan should fund more with its defense and reiterated that in October. That's bearish for semiconductors, right? So those stocks have been getting cheaper. I've rotated, apart from Nvidia, I'm still holding my Nvidia because Nvidia is going to benefit from a Trump regime because they will be permitted to export to countries like Saudi Arabia. And you're going to get less AI controls and restrictions if you have uh, like the crypto AI czar, like David Sachs, calling the shots. That's only going to help NVIDIA, in my view. So on the semiconductor front, what we've done is we've actually rotated our exposure to Seagate. So Seagate's a name here. I'm going to share on the screen. Actually has a decent entry now too, but it's a data center play, right? Because these data centers need more memory storage. It's right at the 200-day moving average. So not a bad entry. Forward PE is 12. So technically, it's cheaper than the S&P 500 if they hit their analyst consensus earnings targets. What I like about this name is, you guessed it, it's got free cash flow. It's got a decent shareholder yield, and um, they have some level of buybacks, not showing on this screen, but some other analytics tool we have in house is showing that there's some buybacks around this. So I think they could be a beneficiary of the data center theme as well. But there's some other ideas away from data centers that are worth looking at. Let's go back to the themes page here. Okay, so software has had a nice counter trend rally. We'll see if that continues into Q1 next year. I think it's mostly a counter trend. I think those names are just so hated. The new narrative is that they're going to reposition and embrace AI, but I think there's a lot more risk to those businesses in the future. Can you truly transform your business to become AI first? Some of them can, uh, but many of them won't, because a faster, more nimbler business that is focused on their customer can build faster than it takes time for engineers to refactor a code base. But the companies that have distribution um, have an edge, right? They don't necessarily need to be the most competitive. So that would inure to the benefit of some of these Mag 7 players as well, right? Meta rolled out a new Llama model. Google rolled out Gemini 2.0 model as well. Meta, by the way, this is hilarious. Let me share this one with you. Meta donated $1 million to Trump inaugural campaign. Look at this. So, yeah, Meta was the CEO, Mark Zuckerberg, had a pre-Thanksgiving dinner with Trump. And don't forget, also in October, Google's CEO gave Trump a call to congratulate him on the viral video of the McDonald's campaign move. So these big tech companies, they get the joke. They understand the power of the executive branch in setting antitrust and regulation. And they understand how to play the game. We're long Meta, by the way, we're long Google as well. So, and they should be playing the game. That's what else are you supposed to do? So, it was encouraging to hear that Elon Musk said he wouldn't use his advantaged position with Trump to her competitors. I think half his time is now at Mar-a-Lago. I was pleased to hear that. We'll see how that actually plays out. I would expect that his businesses do well. SpaceX will get more contracts, right? I'd love to see a tunnel built between New York City and London. That would be fantastic. High speed rail, be great to get that going again, uh, or going at all. So, you know, social media is probably one of the most significant regulatory issues that never really was a campaign topic. Uh, but clearly it'll be one of the most significant issues of our age, and no one just knows how to handle it or approach it. What other categories here? So cybersecurity has been doing well. You know, CrowdStrike uh, largely recovered after their uh, debacle, the cybersecurity breach of all things, some time ago. Banks are doing well. Regional banks, these names have pulled back. They had quite a lift off, but you can see their returns are stronger than almost any category. And I think there's still some room to go. I mean, they're not overstretched on valuation, but they should benefit from an M&A environment and lower interest rates, greater liquidity. So we do like that category. Insurance has been soft recently, but we do like that category as well. Almost all the categories within insurance are very interesting. See healthcare, you see a lot of green on the right, then red on the left. That means they started the year well, and they've been giving back a lot of their gains. We talked about healthcare earlier. Biotechnology, the market needs clarity in what will FDA policy look like. What does that mean? Is it in a regime where you have Vivek Ramaswamy, who's a biotech executive? Maybe that's a bullish case. You get more FDA approvals, more phase 2 clinical trials. Or maybe it's bearish if RFK Jr. is transforming policy around vaccination. The market just doesn't know. So it's in a shoot first, ask questions later dynamic. Ordinarily, that category would be rallying in Q4. It's an animal spirits category. But notably, it has not been. Let's see. Retail, I think, has done all right. I think we'll see good numbers out of these retailers, although you're seeing a separation of winners and losers in that category. Uh, Travel and leisure, I believe, is a very good category. Our boomers are spending money. They're spending money on travel. We picked up a cruise line this morning. You can see this category has performed quite well. So top boomers are spending their time, and the valuations are still reasonable. They're not as wonderful as they were last year, but I think there's still some opportunities there. You're at the 70th percentile valuation in the cruise line category. When that gets to 90, it's time to look for the exit. Utilities have had a strong start to the year. They've been giving back more recently as the FOMO has kind of faded from that category. And industrials have faded recently as well. So if we get some of that breadth expansion, then those categories should do well. I'll pull up again that equal weight index. I think maybe next week or so, we'll see this start to uh, perform, and that would help some of these other categories. China is an interesting category as well. There's so much happening. I wish I had more time to share more. We've actually been interviewing aggressively to grow our team, so that's where I've been spending more of my time. I've interviewed like 15 analysts, and we're going to get some incredible analysts and more engineers as well in the coming weeks, which is super exciting. And a lot of the charts I'm sharing with you here will be able to share to the public. Maybe we can wrap it with SaaS software. I'm not sure. We'll figure it out. But we know it adds value for our process. So I imagine it'll add value for others as well. So China, overall, like China's very complicated. Overall, I do think it's in a bull market, but you can't chase it. So China had this liftoff pump right here. And if you bought in on that, then you got punished. I made a comment on China on Twitter. I want to say like 2 weeks ago. I'll see if I can find it. And I don't know if you remember, but we were bullish on China, and then David Tepper went on CNBC, and we said you should not be. You give this thing 1 or 2 more weeks, and it's done. And if you top tick that, then you're still underwater. But when people stopped paying attention to this category, it was actually a great time to enter. And I think China needs to cool off once again. It just moves too quickly. So you have to be nimble. You have to be on the ball. Uh, I would wait here. I wouldn't get after it now. But there were some good opportunities right around here. So if you can stomach the volatility, but this is now one of the best performing asset classes overall. And this was a non-consensus idea at the beginning of last year. So you saw that mean reversion take place, in China. Um, Now it'll be interesting to think through, like, what are the non-consensus ideas to start next year? Healthcare probably would be one of them. Let's say I still think it's pricing in a lot of the bad news that's come out recently. International value would be another category as well, right? So we'll have to see how the rest of the year plays out. But if US momentum prevails, if US momentum continues to do very well, then the spread between those stocks and international value will grow wider, and there'll be an opportunity for international value to catch up. Those international value stocks are getting hurt because of the threat of tariffs, right? So again, it's like shoot first, ask questions later. So Mexico, actually, I have a short position on Mexico, even though I think maybe in a few months from now, this thing could actually do well. So we shorted Mexico when it got to this blue line here, this technical level. Maybe that'll manage my risk around GM, for example, which has some exposure to Mexico. So, um, but I think some of those things could change. Tanker stocks are also in the dumps. I mean, these things are just totally, tanker stocks are tanking. We used to own some of these names. I got all these names when they stopped working. It's very important to be nimble like that. Uh, we're in wait and see mode on that category. But there's some compelling value in bargains setting up because you have seen a few themes primarily around data center and financials and travel and leisure lead the way since the Trump win. All right. So those are some quick thoughts. Any questions? So we got a question here on quantum computing. Keen to get thoughts on Google's quantum computing chip implications. Too early to make it investable? How best to get exposure to this new paradigm? Fantastic question. So the best way to make money is invest in businesses that make money. These quantum computing businesses are not making money. Uh, Let me share Google with you. So Google had been in the dumps for quite a while. You saw this big red bar here is November 20th, 21st, when the DOJ requested that Google be penalized and spin off Chrome due to their monopoly position. So that news got priced in on that day. Touch eternity moving hours is a great time to buy Google. Then a few things happened. One, new FTC chair that Trump named yesterday, very bullish. So if you're a big tech company, you've got antitrust issues, those issues may go away. That's one. Number two, you had quantum computing that created a pump about 5%. Um, and what else? I think there's some other good news around Google. They had a trifecta. So that really was quite a bargain if you could get it. I still think it is attractive, actually. It's harder to maneuver in position now, but it was quite a bargain here. It goes back to the point you hear me say often. It's like you make your money on the buy. If you get a good entry, then you can be patient. You don't have to chase. The market will catch up to your thesis. If you chase things after they lift off, then you lag, or you have to wait a longer time to get performance. So quantum computing, I think we're in a long ways away from commercial applications of that. The number one customer of quantum computing will be the National Security Agency and any government that wants to crack uh, passwords and encryption. So, it'll be highly regulated. Obviously, there are use cases around genomics and protein folding, which is what Google's focused on. Interesting about that is that we might think of Google as indexed to like biotechnology stocks. Think about that. And Google might play an important role in like life sciences. We don't ordinarily think about Google in that way. Um, but until these businesses generate earnings, they are trades. They're not really investments. They will rally. I'm sure if we can find the Google, let's go find some quantum computing stocks There are several. I've looked into this category before, by the way. There's, you know, I would imagine that they're doing very well right now, but that doesn't mean that if you buy them now, they'll do well a year from now. What are example quantum computing stocks? Show me tickers. Let's go ask the AI. Oh, there we go. IonQ, Rigetti, yep, D-Wave, quantum computing. So Rigetti, by the way, these companies have real operators too. I know some of the investors in these businesses, I've talked about these businesses when I was exploring this theme and category, but what I concluded was they're just not making money. So yeah, there's the pump, right? That's the Q4 pump that you see. This is animal spirits too. This is betting on the future. November 5th, 6th, that's the Trump election, and this is in full send mode, right? Down 20% today, though. Still up massively, massively, right? I mean, $1 on October 17th, right? You were at November 3rd, you were at $1.17. Now you're at $8 2 days ago. Now you're at $6. Massive, massive, right? So that pattern is the nature of animal spirits. Okay, this is the classic pattern. You have a short window of time where you have accelerated ramp ups and moves. And then most of the year, it's actually bleeding out, it's leaking, right? A good example that would be, we talked about ARC earlier. Tesla stock's a very good example of that as well, right? Here's ARC-G. You have these rallies. This one never really, I mean, the 200-day is still heading down on this one. That's ARC-G. That's the biotech one, right? If you look at ARC, again, you have these sharp, furious rallies, and then it gives back. So timing is very crucial if you want to play this game, and you got to be considerate around tax. So this is one reason why I'm excited about launching ETF, because I can get after these opportunities. We track, you can see all these lines on charts. We're looking at these things all the time. They give you insight and a read into public sentiment. What this is saying is that people are getting giddy. People are getting excited. For that reason, I think maybe in Q1 we see some softness early part of the year. I think you get the Santa Claus rally with Trump at the New York Stock Exchange this morning, right? And then maybe you have some softness in animal spirits and a resumption of a rally in quality value ideas, right? But so that's that. Like I want to chase these names here. If you're in it, fantastic. But you have to have been in it, at the right time to benefit from it. These are trades. They're not great investments. Okay, so here's IonQ. Same thing, right? Same pattern. These are, though, they are in a bull market now, though, right? Yeah, the trend is up now. So you just have to be very nimble and very tactical if you want to get involved here. You can see a lot of the volume here. And what we've seen with the hot ball of liquidity is the hot ball of liquidity spends about 2 to 4 weeks into a theme and then it moves on, right? We saw that with China. Here's China, 2 to 4 weeks. That was September to mid-October, and then it moves on, kind of leaks out, right? You saw that with uranium ideas as well. Here's September 11th to October 21st. That's about 5 to 6 weeks, rallies, and then it kind of stalls out a little bit, right? So quantum computing has attracted the hot ball of liquidity. Satellite stocks have as well. So just understand where you are in that, dynamic. You'll be rewarded for exploring areas that are overlooked. That's the premise of non-consensus investing. You want to lead the market. You don't want to follow the market. You want to sell to the people that are following. So that's what Michael Saylor's doing, right? So what about Cameco? So actually, Cameco uranium stock, yeah. I This is a hard read now. This is a very hard read now. Cameco. We actually had a small short position on this not too long ago. We closed it out. By the way, we closed it out recently, so we don't have that view. I used to own this last year. So again, one of the key themes when you talk to me is that very, very nimble, right? Things can change when prices change, policy change. Be nimble. I have no problem changing my mind. So here, like it's more expensive than Nvidia, so I just kind of lose interest right away. The forward PE is 48, the trailing PE is 290. The issue I have with Cameco is that they have not been able to produce enough for uranium, so they're technically short the contracts that they're obligated to fulfill to their customers, which means they've got to buy in the spot market. So, if uranium prices were to spike, that would expose them to some risk. On the other hand, the bull cases, they are the leader. They are an ally, Canada, and they've got enough market cap to do M&A around startups unlocking uranium technology like ASPI and others. So, and it's also on theme. Uranium's on theme. Technically, looks interesting now too. But uranium's definitely a Q4 kind of story as well. You can see that here, right? Bottom September 11th, end of September through now does well. And by the way, it's also correlated to digital assets. People into digital assets also are into uranium, right? And hard assets and things that generate energy. So, uh, yeah, I guess, gun to head, I'd be more constructive than not, given where we are now. Um, but I think you got to be very nimble around these things, right? Here's a name I picked up recently, by the way. You're probably wondering, like, Ron, what do you like? I'll tell you. So here's an example. It's an interesting idea. It's an automobile insurance company. It's got a forward PE of 10 and a half. Also has a good entry now as well, right off the 50-day moving average. It's an insurance company. I like insurance companies. Insurance companies have sold off in the last few weeks, so now they're getting more interesting again. They're right homeowner, commercial automobile, commercial property, umbrella insurance products, and the uh, free cash flow divided by market cap is 25%. That gives them the ability, if they want in the future, to do buybacks. The trailing PE is 7, the 4P is 10. So interesting idea. It's got momentum, has a good trend. It's in a category that I expect will do well because people are obligated to pay for insurance. And it's done, by the way, it's done 92% year to date. So there are a lot of interesting names like there. If you can find them, I like those ideas, right? Like there's so many eyes on uranium and Cameco right now. You have to find the mispriced asset that people aren't talking about that will come into focus from the market. That's more of the style I like. Now, everyone knows Nvidia. Why do I own Nvidia? I own Nvidia because I do believe there's secular growth trend, and the market is underestimating the demand for GPUs. They're underestimating the sovereign demand. That demand hasn't really come online yet. They're underestimating the war that these big tech companies, have to become number one or lose their franchise. So I like those secular growth plays. But they're, if I can barbell that with quality value, free cash flow, buybacks, low valuations, good trend, good themes, good quality customers that have recurring revenue, earnings growth, that's it. If you have earnings growth and a good valuation, by and large, your stock should do well. If you've got a moat around that, it should do well, right? I had a podcast over the summer talking about more of these small caps. I really haven't recently, but if you guys ask me those questions, I'm happy to. But this is a Nova we talked about that. This has done pretty well since the summer, right? This is now it's a 10 forward PE. We bought it when it had a 7 forward PE earlier this year, right? And they're buying back 11% of their stock every year. There's a bid of 11% of the stock every year, and the 11% equals the average annual return of the S&P 500. So if no one buys that company and they just buy that company, I ought to at least do as well as the S&P and maybe more. And it has done more because it's cheap and they don't have much competition. So these names, uh, these names show up on my bad business model list, but have several of these have pumped recently because that's what Q4 is about. Q4, these names rip and they leak going into the new year. I don't know all of them well, but I've seen these hit my screen several times, by the way. So I have kind of a sense about them. Joby, I believe, is like an aviation business. Again, it's got like a cool story, right? All these stocks have cool stories, those kinds of businesses, right? It attracts people's imagination. Let me share that with you real quick. We'll ask the AI about Joby. How about that? This is my AI co-pilot. This is how we stay on top of everything we're doing here. So I have that running in the background. Let's take a look at Joby. So here's Joby. There you go. It's the same pattern, right? This is a classic animal spirits pattern. You have a significant rally right after the election, and then leakage. Here in the summer, you had a rally from April 25th. April 24th was the bottom in the indices last year, by the way. And then you had a significant rally through July 10th and then start to leak out. What's nice about these tickers is that they can give you some perspective on the direction of the animal spirits because their moves are so sharp and violent. You don't have to own them. You just got to look at them. You can see what's the direction of travel for animal spirits. Because animal spirits, if they're moving up, then owning higher beta names can do well. If they're moving down, then you don't want to own higher beta names. You want to own names like value. So there's some signal in these names, but it's a Joby Aviation. Let's go to the AI tool. AI tool is working this. It's pulling in information from all over the internet and sell side research and all sorts of cool places. It takes time to do the work though, so I don't have this cache because I haven't really looked at this name. But I can tell you from a factor perspective, it's got negative momentum. It's very high beta. They don't make money. It's low ROE. The trend on average is down. It's highly volatile. They seem to have a decent balance sheet. So, that's a trade. It is not an investment. That's the main conclusion from that. By the way, let me show you something else around this tool. This is cool. The UX is terrible. I know it. We're getting better on it. This is for internal use only right now. That'll change in about 3 to 4 months. I'll probably put up like a waitlist page. So if you guys are curious and you want to interact with this tool, if you're on there early, we'll get you early access to this. But check this out. This is really cool. This is a charting tool we've built. And I'm starting to use this now. So what we'll do is we can load up a theme. So here's a theme: financial services, banks, restaurant, energy, you name it. And I have all the factors up here: momentum, revisions, profitability, growth, and the chart here. And I can quickly toggle one chart to the next. And I can write a message to my analyst. We have a shared context. Ally at the 200 DMA, and tag it and put a symbol, like call it buy now, let's say, and maybe other names I like, but I'm waiting for them to pull back, like Jack Henry, right? Ultimately, I want the AI to do all this for me every single night and then prioritize and prompt me in the morning. So that's the vision. That's where we want to take this. That would be very cool, right? This is Synchrony Financial. I like this business. They do the retail private label credit cards. You go to Macy's. I think these guys make more money than Macy's. If you get the Macy's card, Synchrony is the one making money. So, and what's nice about this is that if you've got a view on a factor, right? We've had a tremendous momentum factor rally, something I talked about. I mentioned this on Twitter, and I wrote about it in the Lumida Legend newsletter this weekend. This balance between this tension between momentum and mean reversion. Momentum's had an incredible rally. Suppose your view is you want to be long momentum. What I can do here is this: I can click on momentum, and it will sort for the highest momentum stock. What's the highest momentum stock? Dave. We're long Dave actually, but so I can see that's got the highest momentum. If I have a view on that, if I click the next one, FICO's got a decent entry here. It's got a lot of momentum. I can also see right away it's expensive. These are standard deviations. This is negative 1.5 standard deviations relative to the mean. So I can very quickly get a point of view. And if I have a view on a factor, then that makes it interesting. Or suppose I want to figure out what has the most seasonality, the positive seasonality, and click on this. And it says Ally Bank has the most positive seasonality. That's not a primary consideration, but it is a consideration. There are seasonal effects, right? So that's super cool, isn't it? Let me show you this other thing we're doing as well. Again, this is all like skunk works. It's not going to be like super pretty now, but we're using this every day and iterating on it. This is the thematic analysis. I'll pull that up while that's running. I'm going to show you another one here. Let's see. Oh, transcript summary. This is super cool. So one of the things that we do is go through earnings transcripts to identify what are the key trends, what's management talking about, are they spending more, are they raising prices, are they experiencing inflation, what's the consumer behavior, is the regulatory environment improving or deteriorating. It takes a lot of time to do all of that. So with this tool, we will now have the ability to generate uh, summaries of these, not just the earnings transcripts, but we've already done that, right? So, for example, if I go to, let's say Nvidia, I can pull up the earnings transcript for Nvidia, and it'll pull that up in a moment. There we go. So here's the bull bear case for Nvidia. If I want to go see the transcripts, I'll type that in here, and I can see the key highlights. So my eyes know where to focus quickly. There's a lot of information to process. And if I don't have time, I can read the summary of the transcript, and it knows the last 5 transcripts. So it's processed all of that information. Now, the question is, if you're covering multiple themes and you've got 300 stocks in your coverage universe, you need summaries of the summaries of the summaries. So just to orient, and then you can go deep. So here's a summary of the banks. And so we've loaded these banks. There's MUFG, Japanese bank, there's New Bank, JP Morgan, New York Community Bank, Barclays, Walgreens, Flagstar Bank, Citizens Bank, Live Oak Bank. We've got regional banks, we've got mega cap banks. I should add Bank of America in there. And looks like we're missing that one from that list. Easy to add, I just type it in. But it'll then give me a walkthrough of what they're seeing in the sector. And the key themes are cost management, credit quality stabilization, investing in technology, and it'll give me some views. By the way, do not act on these things. By the way, this is not ready yet. We're still teaching it. We're training it. I disagree with some of the views it has, etc. So, but we're iterating on. This is an example of how I see AI transforming investing. I think in the future, a 12 to 15 person firm can compete with like a Merrill Lynch, no question about it. I spent 12 years at Merrill, so I know exactly what they do, and I know what we do and what we can do with technology. So anyway, it gives you key questions to focus on. Then we'll have the AI answer the questions for us, and that's what we're working on. We're ramping up our engineering, so because we're getting value from this, right? And our priority is you know speed up our investment decision making processes, because if you can cover more names and you have an edge on average for every name, then you can be the casino, you can be the house instead of the player. You're extracting an edge over a broad population, right? So let's see, Innova is a question there. Avalanche, I don't know enough about this fundraise token sale. We should talk about on the Bips and Bits podcast on Unchained. We'll do some homework ahead of that. Overall, like I would say, when companies are issuing stock or they're selling tokens, it's usually because they think the price is a good price to sell at. So they also know more about the asset than you do. So would you rather be a seller there? I don't know. I'd rather be on their side of it. So, that's why these IPO markets at their conclusion often mark the end of a bull market, right? In 2007, you had Apollo and Blackstone go public. That's smart money. Private equity companies went public, and within a couple months, 6 months, that was it. You had Goldman Sachs go public. The tail end of the dot-com boom. That's smart money. That's an investment bank that takes companies public. They know how to time their own IPO offering. And we've seen this in 2015. There's a fintech lending boom. You had companies like Lending Club go public and On Deck go public. So they can sell into the market at attractive valuations when the themes are attractive, when the market wants those themes. So, IPOs are a contrarian indicator for me on the tail end when things get sloppy. On the early end, it's constructive because people get excited. People like IPO. They scramble to get access to IPOs. I think CoreWeave, that IPO will actually be bullish for the market. It's a good deal for the market. When you feed the market bad deals, then the buyers go on a buyer strike. The buyers are names like T. Rowe Price, Wellington, BlackRock. Those companies in the public markets don't know these businesses as well as VCs in the private markets. And there's a big information gulf between those two. And they really do buy into these stories when things get like gaga. I've met several of these investors in my former life in the 2015 era. When there was a fintech lending IPO boom, I was an investor in Lending Club. The company went public, was on the Florida Exchange. It was a lot of fun. Back then, you actually had real human beings on the floor, even though by then it was already mostly automated, but I guess it was theatrical. So I did this roadshow and I met a lot of these large institutional investors, and they really didn't have a clue how these businesses worked. So that was eye opening. There's a gulf between private market investors and public market investors. There are stocks and businesses that VCs would think of as dogs in their portfolio that public markets would love. And then public markets wake up and get rational. Eventually, public markets figure things out because what they look for is earnings. And when you're going public, you're selling a story about the future. You're selling a story about future earnings. If they don't materialize, then the public markets they will punish the asset. So we'll see how this IPO market plays out next year. I'm looking forward to that. I think it'll be a good market. Clearly, the AI theme is being rewarded. If you look at Nvidia, the Palantirs of the world, Meta is now getting rated in for AI. Let's take a look at a Meta real quick, and then we'll call it a wrap. So Nvidia, or here we go, Meta. Again, we saw Zuck having Thanksgiving Eve dinner with Trump, and then donate $1 million to the inaugural campaign. Smart move, right? So it's all-time highs, right? And I don't think the market's fully appreciated the AI potential of this business that is starting to happen. All right. You bet. Absolutely. Thank you for the kind remarks, sir. Let's call it a wrap, and we'll see you next week. Make sure you subscribe to the Lumida Ledger newsletter. By the way, if you want to listen to this on the drive, we will have this on Spotify, Apple, and we'll have a YouTube broadcast as well. All right. Take care, folks. Be well. Have a good one.